What if I told you that everything you have been taught about credit is wrong? That the number controlling your financial life can be systematically improved in 12 months by following a specific set of steps that almost nobody talks about? Stay with me. Let us start with the truth that the credit system does not want you to know. Most people treat their credit score like a report card, something that happens to them. But the reality is far more powerful. Your FICO score, the number that determines whether you get approved for a mortgage, a car loan, or even an apartment, is calculated from 5 specific factors. And here's what nobody explains. Those 5 factors are not equal. 35% of your score comes from payment history. This is the single biggest lever you have. One missed payment can drop your score by 100 points, but consistent on-time payments, over 12 to 24 months, they can rebuild a devastated score better than almost anything else. The second biggest factor is credit utilization. That is 30%. This is the ratio of your credit card balance to your credit limit. Here's the secret most people do not know. Anything above 30% starts hurting you. Anything above 50% is seriously damaging your score every single month. If you have a card with a $1,000 limit and you are carrying $600 on it, you are being penalized right now. The remaining 35% comes from the length of your credit history, your credit mix, and new credit inquiries. These matter less in the short term, but they matter enormously over time. Now let us talk about how people get into financial trouble in the first place, because understanding the trap is how you escape it. The average American carries about $6,000 in credit card debt. At a typical interest rate of 22% APR, which is now standard, that $6,000 is costing you $110 every single month just in interest, not paying down the principal, not building anything, just feeding the bank. Here's where it gets worse. Most people in debt make the minimum payment, usually 1 to 2% of the balance. If you have $6,000 in debt and you only make minimum payments at 22% APR, it will take you 23 years to pay it off, and you will pay nearly $12,000 in interest. You will pay back almost triple what you borrowed. But there is something even more insidious happening. When you carry high credit card balances, your credit utilization is high, which damages your credit score. A lower credit score means higher interest rates when you need new credit. Higher interest rates mean more of your payment goes to interest, leaving you with more debt, which further damages your score. This is the spiral, and it is designed this way. The credit card industry makes approximately $176 billion in interest and fees every year. The system is not broken. For them, it is working perfectly. The only way out is to understand the mechanics and then systematically dismantle them. Here is something that will change how you think about your credit report entirely. According to a study by the Federal Trade Commission, 1 in 5 Americans has an error on at least one of their 3 credit reports: Equifax, Experian, and TransUnion. 1 in 5. More critically, 25% of those people have errors serious enough to affect their creditworthiness. That means roughly 43 million Americans are paying higher interest rates, getting denied for loans, and being treated as high-risk borrowers because of incorrect data. Common errors include accounts that do not belong to you, often from someone with a similar name, accounts that were paid off but are still showing as delinquent, outdated negative information that should have aged off, and incorrect account limits that artificially inflate your utilization ratio. Here is your legal weapon. The Fair Credit Reporting Act gives you the right to dispute any inaccurate information on your credit report for free. The credit bureau has 30 days to investigate. If they cannot verify the information with the creditor, they must remove it. The process: go to annualcreditreport.com, the only federally authorized site, and pull all 3 reports. Review every single account. Look for anything you do not recognize, any incorrect balance, any incorrect status. Then write a formal dispute letter, not the online form, an actual letter, to each bureau. Send it certified mail with return receipt. This creates a paper trail they cannot ignore. Most people never do this. The 43 million Americans with credit errors do not dispute them because they do not know they can. Now let us talk about actively rebuilding your credit, not waiting for time to heal it, strategically attacking it. First tool, the secured credit card. You deposit money, say $500, and that becomes your credit limit. You use it for small purchases and pay it off every month in full. The card issuer reports your payment activity to all 3 bureaus, and over 6 to 12 months, You build a legitimate payment history with zero risk of going into debt. Second tool, the credit builder loan. You do not receive the money up front. Instead, the lender holds it in a locked savings account while you make monthly payments. When you have made all the payments, you get the money, plus 12 to 24 months of perfect payment history on your report. It is a forced savings account that builds your credit at the same time. Third tool, become an authorized user. If you have a family member or close friend with excellent credit and low utilization, ask them to add you as an authorized user on their oldest account. You do not even need to use the card. Their account history gets added to your report, potentially boosting your score by 20 to 50 points in as little as 60 days. Fourth, negotiate pay-for-delete agreements. If you have accounts in collections, you can sometimes negotiate directly with the collection agency to remove the negative item entirely in exchange for payment. Get this agreement in writing before you pay a single dollar. Now let us talk about actually getting out of debt, because a good credit score while still drowning in debt is just a prettier trap. There are two proven debt payoff strategies. The debt avalanche method, you list all your debts from highest interest rate to lowest. You make minimum payments on everything, then throw every extra dollar at the highest interest debt first. Mathematically, this saves you the most money. This is the financially optimal choice. The debt snowball method, you list your debts from smallest balance to largest. You attack the smallest debt first, regardless of interest rate. When you pay it off, you roll that payment into the next smallest debt. It is not mathematically optimal, but psychologically, it is incredibly powerful. Watching debts disappear gives you momentum that keeps you going. The research shows this. If you are disciplined and analytical, do the avalanche. If you have tried to pay off debt before and lost momentum, do the snowball. The best debt payoff strategy is the one you will actually stick to. What both methods require, a written budget, automation of minimum payments, and treating debt elimination like a second job. Your credit score is not a life sentence. It is not a judgment of your worth. It is a number, one that follows specific rules, responds to specific actions, and can be methodically improved by anyone willing to learn the system. Start today. Pull your free credit reports. Find one error. Write one dispute letter. It costs nothing but your time, and it could be worth thousands of dollars. If this helped you, subscribe to Credit Fixed. We publish this kind of in-depth, no-hype financial education every single week. See you in the next one.